Open your banking app and look at the number. That number feels like a pile of cash with your name on it, sitting in a vault somewhere, waiting for you. It isn't. Right now, almost none of your money is actually at your bank. The cash isn't there. It was never there. Not in a vault, not in a drawer, not anywhere you could walk up and point to. For every $100 you've deposited, your bank might hold just a few as actual cash you could walk out with. The rest is gone, lent out to a stranger the day you handed it over. What you own instead is a promise, a number on a screen that says you can have your money back whenever you ask. And almost every single day, that promise quietly holds. Until one day, for one bank, it doesn't. So what would actually happen if everyone tried to take their money out at the same time? Not as a metaphor. If you and your neighbors and everyone in your whole city showed up tomorrow morning and asked for cash. The answer is the strange secret sitting underneath every bank on Earth, and it explains a panic that just a few years ago destroyed a $40 billion bank in a single day. Start with where the money goes. When you deposit $100, your bank doesn't lock it in a drawer with your name on it. It keeps a sliver and lends the rest out. That loan becomes someone else's deposit, and their bank lends most of it out again. Your $100 quietly turns into hundreds of dollars of lending, rippling out through the whole economy. Economists call this fractional reserve banking, and it is not a loophole. It is the entire design. In the United States, since March 2020, the legally required reserve has been exactly 0%. The banks decide for themselves how thin to run. This isn't a scandal, it's the whole machine. It's how banking has worked for centuries. The clearest explanation of this ever put on film is a Christmas movie. In 1946, in It's a Wonderful Life, a frightened crowd storms George Bailey's little bank, demanding their savings back. He begs them to understand. The money's not here, he tells them. Your money's in Joe's house, that's right next to yours, and in the Kennedy house, and 100 others. He isn't lying, and he isn't a crook. He's describing how every bank that has ever existed actually works. Even the word gives it away. Bank comes from the Italian banca, the bench that medieval money changers sat at in the street. The whole towering institution started as one guy at a table. So if your money is really out there in Joe's house, what happens when everyone wants it back on the same morning? This exact question won two economists a Nobel Prize. In 1983, Douglas Diamond and Philip Dybvig published a paper with a dry title, Bank Runs, Deposit Insurance, and Liquidity, that quietly laid bare the deepest flaw in modern finance. A bank, they showed, makes a promise it can never fully keep. It borrows short and lends long. It owes you your money instantly, on demand, but it has lent that same money out for years. As long as only a few people withdraw on any given day, there is always enough cash on hand. The trick works beautifully. Most days, nobody even notices it's a trick, but Diamond and Dybvig showed this creates two possible worlds, and a bank can flip between them in an instant. In the calm world, you trust the bank, so you leave your money in, so the bank stays fine. In the panicked world, you suspect everyone else is about to pull their money out, and you know the cash will run dry. So the smart move is to run first, before it's gone. Here is the unsettling part. In that second world, panicking is completely rational. You are not being foolish by joining the stampede. You are being foolish if you don't. A bank run doesn't even need a real problem to start. The fear of a run is enough to cause one. Belief alone can topple the whole thing. No villain required, just fear, moving faster than the truth. Their paper has been cited more than 13,000 times, and in 2022, it won the Nobel Prize in Economics. So how often does that panicked world actually arrive? More often than you'd ever guess, and faster every decade. In the Great Depression, the panicked world swallowed America whole. Between 1930 and 1933, more than 9,000 banks failed. 4,000 of them collapsed in the few months before Franklin Roosevelt even took office, as terrified depositors yanked out their savings and the cash simply ran out. This is also where another word was born. When a money changer in Old Italy couldn't pay what he owed, his bench was said to be broken, banca rota. That is the origin of the word bankrupt. A broken bench, and it never stopped. In 2007, savers lined up for blocks outside a British lender called Northern Rock, the first run on a major UK bank in over 140 years, since 1866. Then came the fastest bank run in history. In March 2023, Silicon Valley Bank looked perfectly healthy on paper, but a whisper spread through group chats and social media that it was shaky, and customers tried to pull out $42 billion in a single day. That was about a quarter of the entire bank gone in hours. The bank couldn't find that much cash. No bank could. Nobody had to stand in a line this time. They just tapped their phones. Within roughly 2 days, a bank that had taken decades to build had vanished. It was Diamond and Dybvig's panicked world, arriving at the speed of a notification. So if any bank can fall this fast, why isn't this happening to all of them, all the time? Because after 1933, governments invented a fix, and it's stranger than it sounds. When Roosevelt took office, he immediately declared a bank holiday, shutting every bank in the country for 9 days just to stop the bleeding. Then, that June, Congress created the Federal Deposit Insurance Corporation. The promise was simple. If your bank fails, the government itself refunds your money. At first, it covered just $2,500 per person. Today, it covers $250,000. And here is the beautiful part. The insurance works mainly by never being used. If you know your money is guaranteed, you have no reason to run. And if nobody runs, the bank doesn't fail, and the insurance never has to pay out a cent. The cure for a panic turned out to be simply removing the fear of one. The numbers are staggering. The year before deposit insurance, 4,000 American banks failed. The year after it began, the number was 61. Same banks, same flawed design, still holding only a fraction of everyone's cash. The single thing that changed was that people stopped being afraid. That was the entire fix. Not more cash, just confidence. Which brings us back to our question. What happens if everyone takes their money out at once? The honest answer is that they can't, because the money, as a physical thing, mostly doesn't exist. It is not sitting in a vault. It is out in the world, as Joe's house and 100 million other loans, and as numbers on screens that all quietly point at one another. Your bank balance was never a stack of cash with your name on it. It is a position in a vast, invisible web of promises. Not a thing you own, a relationship you're part of. So a bank run isn't the system breaking, it's the system being seen. For one terrifying moment, everybody notices at the very same time that the money isn't really there, and they all reach for a thing that was always made of trust. Which is why the strongest vault in modern banking isn't a vault at all. It is everyone else's quiet confidence that they will never need to run. Your money is safe for exactly one reason. Because almost nobody today is testing whether it's safe. The whole towering system rests, in the end, on a shared agreement not to all ask the same question on the same day. So the next time you open that app and check your balance, look at the number one more time. It isn't cash in a vault, it's a promise, held up by millions of strangers all deciding today not to ask for theirs. Money in a bank was never a thing you own. It's trust, stacked on trust, all the way down. And it works right up until the moment we all stop believing it does.